Hello and welcome to this weekly market recap for the week ending Wednesday, September 3rd, 2025. I'm Tom Bowley, Chief Market Strategist at EarningsBeats, and it is a pleasure to be with all of you again this week. We now are into the month of September, the dreaded month of September. Historically, we know this can be a problem for the market. It's the only calendar month of the year where we have gone down more than we've gone up since 1950. So we do have that history that we've got to overcome. We've got the market still in pretty good position. We've seen money rotating away from growth and into value stocks. So at least there needs to be a little bit of caution. And I'll talk a little bit more about that as we go throughout today's show. The big thing this week is we've got jobs coming up. We have the ADP employment report that will be out on Thursday morning. The expectation is for jobs to drop in the ADP employment report. They're still going to be positive, but we're looking for a drop from July to August. And then looking ahead to the non-farm payrolls on Friday morning. Remember the last 3 months with the revisions that we saw going back to May and June. We now have May, June, July, all with barely staying above zero in terms of the jobs, and consensus estimates are once again for jobs to be positive for the month of August, but not much so. I mean, it's still looking to me like a fairly weak report coming out. If it comes in any weaker than expected, I think the Fed is almost guaranteed to cut rates in just a couple of weeks. But we'll talk about that more as we get closer. The stock market and the bond market, I think both are pricing in rate cuts coming in just a couple of weeks. Let's take a look at what happened, though, over the course of the last week. And as a reminder, I'm looking from last Wednesday's close to this Wednesday's close. So that's the week that I'm looking at. S&P 500, NASDAQ leading all the other indices, but you can see everything was red and everything is fairly tightly bunched. So it's just been a little bit of a boring week, a little bit of a pullback, maybe a little consolidation. That's not bad for the month of September. So let's hope that that's all we have is a little bit of sideways consolidation, maybe a little bit of selling. But we do have to be on guard because September can be a rough month for sure. Moving on to the sectors, communication services, the only area over the course of the last week to be up. And communication services had a huge lift on Wednesday from Alphabet or Google. Google got a favorable ruling from a judge about its Chrome, and as a result, Google was up substantially, I think like 8 or 9% today, and that certainly carried communication services and gave that group the edge over all the other 10 sectors. But communication services, like I said, finished as the only sector over the course of the last week to be higher, and we know all the major indices were slightly lower. Going down toward the bottom of the totem pole here, you can see industrials down more than 2%. And then some of the other defensive areas, utilities, real estate, and then more a value-oriented area, materials, those areas also taking it on the chin a little bit harder than the overall market. But 10 out of 11 sectors down over the last week. I think that gives you a little bit of an indication that this weakness is really, even though it's not deep, it is broad. And that's something to keep in mind as we go forward. Looking at the S&P 500 chart, I wanted to just point out a couple of things. First of all, we do remain in an uptrend. There's no doubt about that at this point. If you're just looking at price action, we continue to put in higher highs, higher lows. I find that to be very encouraging. The AD line continues to set new highs, telling us that throughout the trading day, there seems to be more in the way of accumulation than distribution. I think that's also a positive. And as I go through these other charts, I want you to watch this AD line because we're seeing it across the board on all the major indices. So here we've got the NASDAQ 100. Again, this one has been a little weak, and you can see a double bottom here around 23,000. This is where the bulls would like to hold it in the short term. If we do fail to hold 23,000, I think that could potentially set up another 3-4% drop in the NASDAQ 100. So I'd keep an eye on that level. But look at that AD line, also strong, just like the S&P. And then moving on to the small cap IWM, check this out. AD line as strong as it's been over the last several years. IWM's AD line continues to be very, very strong. Off of that April low, we've seen that AD line take off, which tells me that there's a higher likelihood that we're seeing a lot of accumulation on Wall Street. I believe this is an area of the market that will continue to outperform, and it certainly looks better than the S&P 500 and the NASDAQ if we're just looking here over the last few weeks to a month or so. So IWM continuing to pick up. I like the look here. Communication services. So I mentioned it was the only group that's been up over the last week, the only sector. Check out what happened today. A lot of this, again, certainly coming on the heels of that favorable ruling for Google relating to Chrome. But we got a big breakout, and I've been talking about Google and the fact that I really like the stock. I think it's been accumulated more recently. This is a stock that I've been tracking regularly at EarningsBeats for our members. We have a what I call key manipulation Excel spreadsheet where we've got about 20 stocks, and looking, and a lot of them are the larger names that most everyone would recognize. Many stocks like Google and Meta and Amazon, all the Mag 7 stocks. Throw in Netflix, throw in DoorDash, Palantir, some of the others like that. Just a lot of the bigger names. Anyhow, what I've been seeing in Google has been intraday accumulation that also matches what we've been seeing on the daily AD lines. So I think that that's a stock that is likely to go higher even after the gap up that we saw today. But we'll look at that chart in more detail in just a minute. But within communication services, you can see the internet group making this breakout. Of course, internet also being swayed quite a bit to the upside by Google and Google's performance on Wednesday as well. But very, very nice breakout. Not only a breakout here, but if you look down at the relative chart, down here on the bottom, this shows the internet index divided by the S&P 500. We had a peak back in February, right before we went into the cyclical bear market. Coming out of that, we've been working our way up. Finally, we broke out on a relative basis above that early February high. So I find all this to be very bullish, not just for Google, but for the entire industry group as a whole. And of course, check out that volume today on the move. That also confirmed a lot of strength here today. All right, let me take a look over at our website, earningsbeats.com. If you are new to us at EarningsBeats, or if you've been following us for a while, I want to just point out a couple things. First, you can get no cost 30-day trial. Again, totally free. There is a credit card required, but you would have a free 30-day service by clicking on that button. You can check out everything we do for our members, kick the tires on our service. I think it would be a good choice to check out. If you scroll down, we have a free newsletter. Our EarningsBeats Digest comes out twice a week, normally Mondays and Wednesdays. This week, of course, Monday was a holiday. Sometimes we'll send it out on Monday. This week, we sent it out on Tuesday. But if you sign up for that, all it takes is a name, email address, no credit card required. Just hit that blue subscribe button and we'll get you set up. You can check out the QR code on your screen, and you can scan that, and that'll take you to a landing page where you can sign up on your mobile device. But I want to show you the digest, the EB Digest newsletter article that we sent out because it was very, very timely. This internet giant looks poised for more gains ahead. This went out on, it was out yesterday. It was out on Tuesday. I sent this out talking about Google and the fact that we had the breakout. It was showing some excellent signs in terms of its AD line. Also, if you connect Google relative to the internet group, if you connect all of its relative highs where we've been seeing a downtrend, recently that was broken to the upside. And of course, internet stocks relative to the S&P 500, I pointed out, have been strengthening all the way since back in April at that low. It went out on Tuesday morning, And then on Tuesday at the close after the bell, that's when the announcement came out and Google jumped $20. So this was very timely coming out on Tuesday morning before the late Tuesday afternoon announcement. And then, of course, had a big day on Wednesday. So I just wanted to point that out. Looking at our strong earnings chart list at EarningsBeats, here are a number of names that have reported solid results in the last quarter. The way you get onto our strong earnings chart list, first filter is company must beat revenue and earnings per share estimates. So whatever those estimates are out there, you have to beat both revenue and earnings per share in order to be eligible to go on to our strong earnings chart list. So here are some of the names that are worth considering: Reddit, Google, Yext, NetEase, DoorDash, Meta Platforms, and Ziff Davis ZD. So here's a chart of Google. You can see with that big breakout today, just a massive move to the upside. And look at that AD line just soaring on the stock. So I don't know. It's, gotten ahead of itself here a little bit in the short term. But when you look back, I mean, there really has not been much in the way of filled candles. A red filled or a black filled candle would indicate a lot of selling intraday. Don't really see much of that over the past couple of months. It's been mostly hollow candles where we're seeing a lot of intraday accumulation, in my opinion. I think this is a sign Wall Street is heavily accumulating Google. And I think in time, this is a stock that probably goes to 300, 350. And when I say in time, I think it could happen within 6 to 12 months. So really like Google. I think this continues to be a really strong performer for the market as we go forward. A couple of things from a seasonal perspective, I think worth noting, because I've gotten a lot of questions from members talking about, hey, growth stocks seem to be, kind of taking a back seat. Is this going to be something that could lead to a bear market? Well, slow down. A couple things you got to think about here first. If you look at growth, large cap growth, which the iShares is the IWF, versus large cap value, which again, the iShares is the IWD. If you look at these two ETFs and you look at the relative seasonality, in other words, when does the IWF, when does large cap growth outperform large cap value from a seasonal perspective? Well, when you pull this up over the last 13 years, which is basically during this secular bull market run, you'll see that May, June, July, and August. If you zoom in down here, you can see May average outperformance over the last 13 years by growth stocks, 1.5%. June, 1.5%. July, 1.2%. August, 1.2%. If you add those up, that's 5.4% of average outperformance each of the last 13 years during those 4 months. That's a lot of outperformance. But guess what? It's not August anymore. It's September. And so as we start to see some of this money rotate away from growth, you have to understand that's been the historical trend. Look at the percentages as we go forward, September through the end of the year. Growth historically underperforms value over the course of the next 4 months. So I do get nervous when growth is underperforming value, but you have to understand that there are certain periods of time during the year when it's more normal than others. So I think right now I wouldn't read too much into the fact that the IWF has been underperforming. In fact, I think that could continue for a little bit. I don't know that we'll see a whole lot more of outperformance, not like we grew accustomed to over the last 4 months. I don't think we're going to see that again probably until sometime in 2026. Doesn't mean that the growth stocks won't work. I just think that they'll probably go up together, growth and value in the fourth quarter. That's what I would be looking for. One other seasonal chart that I wanted to show you was the airlines. And I want you to look back over the last 13 years again during this secular bull market and look at airlines and how they've performed their average returns September, October, November, December, January, and February. If you add all of those going across, you're going to come up somewhere in about the 19% range. If you add up February through August, you're going to come up with something that's way less than that. In fact, I think it's negative. Let me add these up real quick. That's -3. That's 1.82916. Yeah, it looks like if you add up the average gains for these other 6 months of the year, actually not February, starting in March, that would come up to looks like about 6 or 7% down on average. So I don't know what it is about airlines. Maybe it's, maybe the market starts to look ahead to spring travel. It always says the market, one of the things about stock market, it's always looking ahead 6 to 9 months. Maybe that's why. Maybe that's why the latter part of the year and into the very beginning of the year, maybe it's already looking ahead to the spring and summer travel next year. And I don't know. That's the best guess I can come up with. But anyway, it is something to be aware of, and just thought I'd point that out. Now, I want to talk about one more thing before we wrap this up. I want to talk about the history of bear markets. So if you look at this spreadsheet that I've put together, this just shows you the date that cyclical bear markets have started and dates that they've ended. And then coming down here, there are 3 secular bear markets, the date they've started, ended, the number of days they've lasted, the start price, and this is all based on the S&P 500, but the start price, the end price, how much the bear market decline actually turned out to be, and then how we perform after that, going out 1 year, 2 years, and 5 years after the bear market. What I want to focus on here is the fact that if we look at the cyclical bear markets, I find this to be interesting. January started one of the cyclical bear markets, but look, February started 3 of them. So between January and February, there have been 4 cyclical bear markets that have started. If we go into the middle of the summer and toward the end of the summer, so we start with July and then go into August, we also have 4 cyclical bear markets that start during those 2 months. 1 here in July, 2 more here in July, and then 1 in August. Now, we topped on August 30th. That was Thursday, August the 30th. That's when we closed over 6,500. So looking at the history, you might think, well, maybe this is it. Maybe this is the start of another bear market. And I'm not saying that it's not. We don't know. I don't think it is. First of all, I think typically I would expect that bear markets would start in February or July. And the reason I say that, and 6, by the way, 6 of these 12 have started in either February or July. Think about the history of the market. The stock market's best performance comes from the end of October through about 2/3 of the way through January. So if that's the best time to be in the market, it seems like right after that would be a good time maybe for a bear market to start. And lo and behold, we've got one that was on January 4th, but we have 3 that did start during the month of February. 2/9, 2/19, and 2/19, different years. But that kind of makes sense to me. And then July and August, the July 15th, 17th, and 20th is really interesting to me because I've pointed out on many occasions that you don't want to go away in May. The best time to go away, the worst time in the stock market historically, has been from the July 17th close through the September 26th close. Look at these dates: July 15th, July 17th, July 20th. 3 of the 12 cyclical bear markets that we've had since 1950 have started right about that time when that's the real go away period, which I find, I just wanted to point it out. The fact that we've kind of gone now 6 weeks past that date and we were still setting all-time highs, we've got interest rate cuts coming. I just don't see a bear market. Um, I could be wrong. I do think September creates or presents obstacles. I wouldn't be surprised if the market does kind of go sideways here in September, maybe pulls back a little bit. I just don't think it's going to be to the extent of a bear market. Maybe I'll be eating crow here in a few weeks. Who knows? But I'm just telling you what I'm seeing right now. I just don't see that kind of behavior. And especially, I don't see it in consumer stocks. And to me, that's one of the most critical signals of seeing a potential bear market decline. Normally, money rotates away from consumer discretionary and into consumer staples before a bear market begins. And we have seen none of that. So, anyway, that's all I have for this week. Who knows where we're going to be next week, but watch those jobs reports. Thursday morning ADP, Friday morning non-farm payrolls. Let's see how the market reacts to it. If they come in weak, it's almost guaranteed we're getting a rate cut in a couple weeks. Have a great rest of your week, everybody, and I will see you next week. Happy trading.